Hello traders, and welcome to the StockGoodies Chart School. Chart patterns are without a doubt one of the most useful tools when doing technical analysis of stock charts. And when you do a Google search for the term chart patterns, you get 28 million results. And that means that chart patterns are a very popular subject. And the reason is, chart patterns put all buying and selling pressure into perspective by consolidating the forces of supply and demand into one concise picture. As a complete pictorial record of all trading, chart patterns provide a framework to analyze the battle raging between the bulls and the bears. And most importantly, they can help determine who is winning that battle, allowing traders to position themselves accordingly. Chart pattern analysis can be used to make short-term or long-term forecasts. The data can be intraday, daily, weekly, or monthly, and the patterns can be as short as 1 day or as long as many years. Chart patterns fall into two main groups, reversal and continuation. Here is the double bottom reversal chart pattern that's usually found after a long fall in the stock price and where it reverses and starts to go back up again. Okay, this is one of my favorites. It is very useful. I'll explain more about it here in a little bit, but let's just run through here. Okay, so this is a reversal. The same thing with the double top. This is a reversal of trend after a stock has been up in a long uptrend. You're looking for a double top or M-shaped top chart pattern. Okay, so that's also a reversal. Now this is a continuation. It is an ascending triangle with a flat top and an upward sloping level of support between the lows. Okay, this in an uptrend, when you see an ascending triangle in an uptrend, that is bullish when it breaks above the upper line of resistance. It is a continuation pattern. Same thing with the cup and handle. When a stock is in an uptrend and it forms a lazy double bottom that is more curved, and the second low here is not down here by the first low or higher, just a little higher. It's more than halfway up the distance between the neckline resistance, this red line here, and the low. So here is the cup, here is the handle. It's like a coffee cup. And when it breaks above neckline resistance, it should continue on up. Now this is a bullish reversal pattern. It's called an inverse head and shoulders. Imagine somebody standing on their head. This is their head, this is their left shoulder, and this is their right shoulder. Okay? The red line is called neckline resistance, and when the stock, after setting this low here, breaks above it, that is confirmation that the inverse head and shoulders has been successful at predicting a reversal of trend. Now these are usually found after the stock has fallen quite a ways, and the reversal of trend means that it will start to go up again. Now this is a bearish reversal chart pattern called the head and shoulders, where this is the head, this is the left shoulder, and this is the right shoulder. It is usually found after the stock has gone up quite a distance and needs to retrace. And this is also the neckline support, and when the stock breaks below it, that confirms that the bearish head and shoulders chart pattern has been successful at predicting a fall. Now this one is called a flag. It's a continuation pattern that is found in uptrends, and what it has is two trend lines drawn between the lows and the highs, and when it breaks above the upper trend line, that is considered a break above resistance and is bullish, and the stock should continue up. Here is the inverse of this. This is called a bear flag, and it's usually found in serious downtrends where the stock will trade sideways with a rising level of resistance and a rising level of support. And when the stock breaks below this bottom red line, which is support, it will most likely continue down. Now here's another continuation pattern. It's called a pennant, and the same thing as the previous ones. This is the trend line resistance. This is the trend line of support. Looks like it had room to zigzag a couple more times inside of this little angle right here. But nevertheless, when it breaks above the upper line of resistance right here, it will continue on up in most cases. Here is the inverse of this form of pennant, and this is called a bear pennant, usually found in downtrends. The stock will consolidate with a lowering of the highs, and the lows are higher, so it forms a pennant. And when it breaks below the lower support line, the stock will usually continue on down. Now, this is called a rectangle, also a continuation pattern. The stock is going up. It takes a pause to run sideways but down. So the resistance line at the tops is parallel to the support lines at the bottom. When the stock finally does break above the red resistance line right here, that is a bullish signal, and the stock should continue up. And this is the inverse. This is a bear rectangle, usually found in downtrends, where the stock will consolidate for a while, rising slightly at the highs, with support also higher at the lows. And when the stock breaks below support at the lower trend line, it will continue down. Now this is very similar to a pennant, but it's called a symmetrical triangle, a continuation pattern found in uptrends and downtrends. And the reliability of this one's not as great as some of the others, but it's the same concept. The stock is in an uptrend. The highs are getting lower, the lows are getting higher. It forms a triangle, and when it breaks above the resistance line right here, it should continue up. And the same holds true for stocks in a downtrend. The highs are lower, the lows are higher. It forms a symmetrical triangle, and when stock breaks below support at the red line right here, the trend line, it will usually continue down. Same thing for wedges, except they point down more. They are also continuation patterns. This is a bull wedge where a stock is going up, then it makes a real sharp turn to the downside, but then breaks above the resistance line here, and it should continue up. Same thing with the bear wedge. Stock is in a serious downtrend. It forms a very sharply up pointing triangle, and when it breaks below the lower trend line, it should continue down. Now this is also a very reliable chart pattern. It is called a descending triangle with a flat level of support and a downtrending level on the highs here, which is resistance. Okay, they can be found in either uptrends or downtrends, but work better in downtrends, where the stock runs flat at the lows. When it finally breaks below support, it will usually fall, and fall pretty hard. This is a very reliable chart pattern. Just like its opposite, the ascending triangle, the descending triangle works very well. Now that you basically know how chart patterns work, in part 2, I'll be loading up a number of different charts that have various chart patterns on them to show you that chart patterns do work. Take, for example, ENER. This is a descending triangle that took almost 6 months to develop on a daily chart. Okay, when it finally broke through this area of support, both of these green lines, once it broke support, the ascending triangle was successful in predicting that the stock would fall from $10 down to nearly $7. Okay, so that is a bearish chart pattern that when support is broken, you can expect a pretty serious move to the downside. And we'll look at a number of different charts, both bullish and bearish, continuation and reversal patterns.